Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
We begin this hour with stocks rising ahead of CPI data and better than expected results from both JPMorgan and from Wells Fargo. Joining us now to discuss is Ken Leon of CFRA. Ken, you've had about 15 minutes to pore over those numbers. What do you make of them?
Well, it's great. So we had outsized gains for these stocks last year. And what the results speak to is the ability to earn into your valuation. I would expect the street is going to have upward earnings revisions for 2025. Take a look at 2026. As noted here, what's the delta for driving that earnings? And that's about really for JPMorgan first would really be net interest income. So it's not just rates as noted here, but it's also volume, which speaks to the U.S. economy growing about 2.5%. Those two flywheels drives net interest income, which is significant for JPMorgan and other banks. The other delta that we haven't spoken about is investment banking, and it might start slow, but the ability of a risk-on environment for mergers and acquisitions and also equity underwriting means that we're going to be moving further up from the trough of the market or the cycle about 18 months ago. Additionally, when you look at, again, net interest income, but JPMorgan is a diversified bank, so it's getting that from many different types of services. The only negative here in the print was really community banks, a little bit slower in terms of their net revenue. But mostly this is a monolithic global bank, well-placed, trading at an expensive valuation. Our takeaway is stay the course, and they're going to grow into their earnings and valuation.
Ken, another figure, fourth quarter provisions for credit losses came in at $2.6 billion. The estimate was higher at just over $3 billion. Similar story for Wells, a lower number than expected too. What does that say to you about credit quality? Are we in a period or at least getting very close to normalization?
Yeah, for JPMorgan, then the industry. So bank analysts are a nervous lot, and the concern is always on credit risk and major write-offs. And so far, the economy's resilient. We're nowhere near an amber or red alert in terms of significant need for buildup of credit reserves. Looks like we're going to have a pretty good year for the economy. And when you look at the consumer, certainly as you do see increases in allowance for bad debt, it's mostly because the volumes are much higher today than they were 2 or 3 years ago. Ultimately, and we didn't speak about this, which is whether it's on credit risk or on trading, is that black swan event. So Jamie Dimon mentions geopolitical risk. The third I would ask is some liquidity squeeze in a complex trading product that upsets the market and maybe the bank stocks. We haven't seen it here. If you go back in 2023, that was Credit Suisse.
Ken, 30 minutes ago, I asked you what's your favourite, what kind of business do you want to own, and you were loving Goldman Sachs. Do you love them a little bit more after those numbers?
We do, and I think there's a more dynamic story here for Goldman. They'll underpromise and overdeliver, I think, through most of 2025. The traditional businesses are going to get the benefits of positive trend. M&A, of course, with $1 trillion of private equity investments that have to be monetized in the next 24 months. CEO confidence is coming up. We're also seeing, with higher equity market values, great trading. But John, the story is, and if I was Goldman management, I'd be talking about their really pivot to having durable, recurring fee revenue businesses across. That would be an asset and wealth management. They're large businesses. And then also, as we see the easing of regulation in Washington, you're going to see Goldman be more of a principal actor besides just an agent for transactions. And what that means is getting to be more of a participant in direct private equity and private credit. We saw that as part of their announcement earlier in the week of blending some of these businesses so that they can partner or compete with Apollo, Ares, and others.
It is a different model, Ken, because for most of the big banks, the way that they've been approaching private credit is partnerships. Goldman, with that announcement, to your point, shows that they can compete with some of the big names. Which of the model for the banking sector do you think will ultimately win out?
Depends who you are, but I think Goldman can play offense. So they can certainly, as I said, be principal and compete. But also for asset-backed loans, they can also be there to also provide funding for the private equity firms. The traditional banks have a different game, particularly regionals or mid-size, which is really loans or syndicate loans competing against a corporate who wants to just get immediate attention with a direct borrowing from a private equity firm. And it's a sea change because it's moving up in size of the deals from small mid-sized companies to much larger deals over $1 billion. So it's a multi-year trend. I think Goldman, again, you have to go back over 10 years. Goldman couldn't be competing with Blackstone and KKR because of regulation. And we're going to see a little easing of regulation, but they're going to be smart because they want to have the right strategy and execute.
Ken, I want to go back to John's earlier point to Sonali. Do you see any weakness in any of these earnings?
The weakness is really related to any sharp change or shock in the markets that affects volume, but also affects in their books exposure. And I mentioned it at the hour before, which is really the black swan event. Some complex derivative product that has a ripple effect, whether it happens in Asia or Europe, but it impacts Goldman. Generally, the other one, which Jamie Dimon speaks to, is a geopolitical event. That has usually been, if there's any sell-off, a buying opportunity. But what we're seeing so far is confirmation that 2025 stayed the course, and we're going to see, I think, the consensus or street analysts raise their estimates as we go through the year.
Ken, we spoke to you about 30 minutes ago. I'm going to say this for you. You gave Goldman Sachs an A+. What does Citi get this morning?
Well, we'll give them a B. I haven't seen the details, but picking up from what Sonali said, the return on equity narrowing the range, they took a $1 billion restructuring charge in 24. So the ability possibly to reduce costs or more than the street thinks might be able to help them on ROE. Citi is also an event-driven stock of the large banks. They are finally, this year we hope, moving to monetizing, selling in Mexico, Banamex, which was by far the largest consumer bank they had outside the U.S. So that's significant. It's event-driven. They also have stable businesses with more transparency. That's called services. It's treasury and trade solutions, a dominant position in the corporate treasury market. And certainly they're more on the fixed income side versus equity across banking and trading. So I think Citi's going to be fine, and they're still trading below net tangible book value, although the gap has narrowed a bit. So we need to see results improve through 2025. But I think myself and most analysts with buys think that they can execute. Jane Fraser is still on course.
She's still on course. That gap maybe even narrowing more this morning with the rally still ongoing pre-market. Ken, another headline that came out is that they see their expenses for 2025 slightly lower than $53.8 billion. That is the high end of their range that they had already given to this market. Does it concern you that they aren't bringing in expenses quicker in the midst of this restructuring?
Well, it ties in with my earlier point, a $1 billion restructuring, but what they're doing is reducing management layers and also realigning businesses that weren't really responsive to the markets or customers. So I think it's a timing issue, and one where you'll see accelerated improvement perhaps in the second half of the year, but you'll see improvement. But it just doesn't happen in 1 or 2 quarters.
Hey, Ken, appreciate your time. Thanks for this morning. Ken Leon there of CFRA on Citi. Pete Hegseth appearing on course to win confirmation, dismissing accusations of past misconduct in his Senate hearing. Secretary of State nominee Marco Rubio among those speaking on Capitol Hill later on this morning. Then Treasury Secretary nominee Scott Bessent appearing on Thursday. Joining us now to discuss, Jennifer Flitton of Invesco. Jennifer, welcome back. Any reason to believe that some of these nominations might be in trouble? Any trouble at all?
Well, I think what we saw yesterday is that a lot depends on these hearings. And objectively, Pete Hegseth did a pretty good job, and it is now taking him on the path to confirmation. I think he'll skate through the committee approval, and he'll be on the floor probably sometime next week. The other more controversial folks like Tulsi Gabbard or Robert F. Kennedy Jr. I think these hearings are really going to matter. And if they have some of the same showing as Pete Hegseth did, then I think they're well on their way to confirmation.
Jennifer, if they're going up for the hearing, though, the Trump campaign must think that they have the votes for these individuals like Tulsi Gabbard and RFK Jr.
Well, I think they have faith in their strengths, right? And one thing that is sort of a through line with all of these nominees is their strong ability to communicate, their ability to message and stay on message. And I think you're going to see that with Tulsi Gabbard and with Robert F. Kennedy Jr., with Patel for the FBI director. If they have strong showings at their hearings, and I think the faith there is with them from the transition, then I think they're well on their way to confirmation. And what we're hearing behind the scenes with the meetings that are happening with the senators is that they're gaining a lot of support as they move along.
It's a good point you make, because that's what sources close to Trump tell me, that being able to communicate his agenda is just as important as being able to do the job that he's putting some of these nominees in place. Can you give us a sense of what's so different from Trump 1.0 and how they worked with nominees and some undersecretaries and what we're seeing now? Are they moving faster now?
They're definitely moving faster. I mean, I think the vetting was a little slow because of how they decided to do it and when they brought in the FBI vetting and when they started filing with the Senate. But I think they're well within their way, well on the path to getting folks in immediately as soon as the president is inaugurated on day one. I do see a much sort of stronger bench in the sense of the ability of Trump and the Trump transition team, and really Susie Wiles at the top there as the chief of staff, to get folks in who are really speaking the message of Trump and Trump 2.0. I think in 1.0 you saw sort of the mechanism in Washington really working to influence Trump. Now Trump has a very strong position and has a whole team of folks who are there to push that position, to push that agenda.
Beyond just the ability to get these various cabinet members confirmed, Jennifer, does it also speak to a cohesion within the Republican Party that will benefit Trump as he tries to do things like pass one big, beautiful bill in a very slim majority? Does it help that these are getting through? Does it speak to that ability?
Yeah, absolutely. And I think we've seen it just in this transition period. Mar-a-Lago is a very busy place right now, and not just with CEOs from the tech industry. You see Washington basically flying down to Mar-a-Lago. He has been entertaining members of Congress, senators, entire caucuses and factions of the House of Representatives. I think going forward, especially within this first 6 months, you're going to see a very hands-on White House, really working their agenda and working with the members within the House who might be the most difficult to get on board.
Jennifer, appreciate your time. Jennifer Flitton there of Invesco. David Kelly's with us around the table. David Kelly of JPMorgan Asset Management. David, good morning. Good to see you.
Good morning.
You expected to see more of this, softer inflation prints in the months ahead?
Yes, I do. I think it's important to recognize that the year over year, which is kind of high right now at 2.9, that's going to look a lot better by April, because the first 4 months of last year, we saw pretty strong inflation. So that makes it very easy to get down to a low 2s by April. And overall, this is not an inflation-prone economy. I mean, the economy left to itself is just chugging along, steady growth, a little over 2% growth, unemployment very steady, and inflation gradually coming down. So, the economy itself looks pretty good right now. It's got a lot coming up on the plate here, but overall, feel pretty good about inflation.
We'll talk about what's coming up on the plate, and I assume you're talking about incoming policy changes potentially. You've written about this. Sources of inflation, labour, energy, goods and services. Where do you have the most confidence now?
I think the most important is the labour market, and I think what we've seen is American workers just won't ask for a raise. It's remarkable. I mean, we saw production non-supervisory workers' wages up 3.8% year over year. We've got 8 million job openings. Everybody knows it's hard to find a good employee, but yet quits rates are below where they were before the pandemic. And either American business is great at saying why they're not going to give people a raise, or American workers are just wimpy about asking for one. But whatever way it works, we're just not getting inflation coming out of the labour market. And without that, you cannot get sustained inflation.
Just to that point on the labor market, as we're digesting CPI, you have had these individual announcements from companies, be it from Meta, Microsoft, Southwest, Citi, when it comes to benefits, about reducing hiring, not hiring, or even letting people go. Does some of that softness, do you look at that and say these are idiosyncratic company events, or does it suggest that something has indeed shifted in the labor market in terms of who has the power and overall represents some form of softness?
I think it's good messaging from these companies. There's nothing like announcing prospective layoffs to quieten down the labour force. So I think it's a way of really suppressing wage gains. There's no evidence in GDP. I mean, if you want to figure out where employment's going, look at where GDP has been, because the last 4 quarters, the current quarter and the previous 3 quarters, are a very good driver of payroll employment. So I know that the rate of growth of this economy is capable of generating 150 to 175,000 jobs per month as an average through this year. And that forecast is good for at least the next 3 to 6 months anyway. So there really isn't any softness in terms of the overall economy, but businesses, they focus on margins, they focus on efficiencies, how can we be more productive? And yes, if that means announcing, well, we're going to have to lay off a few people, then that actually works in terms of maintaining cost control.
David, John mentioned energy, and that was a big part of this inflation story for this print, 40%, I believe.
Yeah.
IEA overnight was saying actually they see a smaller glut next year. How concerned are you that fighting energy prices, higher oil prices, higher gasoline prices is going to be a concern for 2025?
Not too much. I mean, if you look at the global composite PMI index, you've got a global economy that is kind of muddling forward. The US is doing very well, and places like India and Italy are doing well, but a lot of Europe and particularly China are pretty soft here. That's not going to generate a lot of demand. Meanwhile, I think with the change in administration, you could get 2 things. One, you may get a peace settlement in the Middle East, which could dampen down tensions a little bit and concerns. And then secondly, you're going to have a very pro-drilling policy, which could increase US production, and some deregulation, which could help the energy sector. So overall, I don't think energy prices for fossil fuels are likely to go up significantly over the next few years.
If you are just joining us, welcome to the programme. 7 minutes ago, inflation data dropped and came in a little bit better than expected on core CPI, excluding food and energy, month over month, coming in at 0.2%. The median estimate in our survey was 0.3%. On headline inline at 0.4%, the estimate was 0.4%. Of course, we're trading off the back of that downside surprise on core CPI, and it's unlocking much lower bond yields across the curve. The 10-year is now lower by 10 basis points, the 2-year down by 9. That unlocks some dollar weakness and euro strength, euro dollar at 103.40, and equities, a really big lift to stocks. On the S&P, up by 1.4%. Likewise on the Nasdaq, and on the Russell, the small caps are absolutely flying this morning. On the Russell, we are rallying pretty hard going into the opening bell, up by 2.9%. David, you talked about the incoming administration. Danny talked about this earlier, the cost of not making your plans clear. You think it's high yields. Is that what's playing out in the bond market? Not this morning, but leading up to this move.
Oh, yeah. Yes, I absolutely. Because we don't know how far we can push the global bond market. And on Friday, we're going to get some new numbers from the Congressional Budget Office looking at, if we don't do any tax cuts from here, if we don't even extend the tax cuts we've got, I think they'll still show the debt to GDP ratio rising to about 120 to 125% of GDP by 2035. it looks like the budget deficit for this year could come in at over $2 trillion, and half of that is interest. And these higher interest costs that we're seeing, it's a negative feedback loop because it's actually pushing up the deficit. And the question is, well, how much can the government borrow from global capital markets at very cheap rates?
You said in your note, the most dangerous 3 words in economics are, quote, wait and see.
Yep.
What do you do then in this environment where Trump wants to be unpredictable? That's part of the policy.
Yeah, and it works, it works well in football, it works well in military maneuvers, it does not work well in macroeconomic management. You actually have to let people know. I mean, that's why the Fed spends so much time saying we're looking for 2% inflation and just tries to, telegraph their punches all the time. And that's really what you should do in macroeconomic management. So, yes, I think there is an uncertainty tax. Absolutely, because the problem is that if you don't know what the administration is going to do in terms of taxation or deficits, you don't know where interest rates are going to be, what's the easiest thing for business to say? Well, let's wait and see. And when everybody decides to wait and see, what they eventually see is not good. So it actually drags on the economy. It slows down economic growth. So I am not concerned about the economy accelerating a lot this year at all. I'd be more worried about it decelerating if we have some shock or make some mistake.
To Anne-Marie's point, though, this president, the incoming president, values a lack of predictability.
Yeah.
Are you saying that's going to be a permanent feature of this bond market through this administration, a yield premium, because we just won't have a clear plan?
It could be, but also because we're going into uncharted territory in terms of how much we're trying to borrow from the biggest borrower in the world is going to be borrowing more than they've ever borrowed before. We're at a delicate point here because we really need to, not only do we have to have a sensible plan in terms of revenues and spending, but we need a certain amount of predictability. If we sort of push through a budget plan which suddenly pushes us to a $4 trillion deficit and everybody says, oh, it's okay, we're going to grow our way out of it. We're not going to grow our way out of it. I mean, we have to do some sensible budgeting here. And yes, I do think that could push up long-term interest rates. And as I say, it's a feedback loop because that pushes the deficit to GDP ratio up to 7%, 8%. Those numbers make it very hard to finance this debt.
It's pretty a negative cycle. David, it's good to see you. As always, appreciate your time. Joining us now to continue the conversation, Aditya Bhave of Bank of America Global Research. Aditya, you made a call in the last week off the back of payrolls. No more rate cuts in 2025. Does this data point this morning change things on the margin at all for you and the team?
No, I don't think it changes our mind, really. It's a good number, 0.2% on the core PCE. We were below consensus at about 26 basis points. This was even softer than that. But what's different this month relative to previous months is that we already have the PPI data. So we can very quickly go from reacting to CPI to then doing the read-through to PCE, which is what really matters at the end of the day. And if you look over the last 3-4 months, we're basically running at around 2.5%, which is where the Fed thinks we'll be at the end of this year for the core PCE. So by the Fed's own admission, inflation is stuck around 2.5%. And then also on top of that, the labor market seems to have stabilized. And that was the primary reason they were cutting. So we don't see any reason for them to keep cutting now going forward.
Aditya, in that same call you made, you also said that should core PCE come in somewhere above 3%, then we'd start talking about hikes. With this data in hand, even if it doesn't change your call when it comes to no cuts, does it at least move us further away for having to talk about hikes?
I think that's fair. We were pretty upfront about the fact that the bar for hikes is still quite high. So getting to 3% is not a trivial thing, right? Even setting aside this latest data print, as your previous guest mentioned, we are going to go down on the year-over-year rate over the next 3 months, most likely, because the base effects are very favorable. So I won't be surprised if we're around 2.5% once we have the data through March. So to go from there to 3% is going to be very challenging, and it'll probably take some sort of exogenous shock, which could get hikes really into the equation. But equally, our point for now is getting from there to 2% looks quite challenging, which is why we don't see a rationale for continued cuts.
Is there some degree which we should look at these data points as a jumping off point? That is to say that we are going to see inflation's true path coming forward once we pass the inauguration, once we hear different policy for Donald Trump. Is this only the beginning of something that, again, could be an inflationary path?
It's possible. We'll really have to see. I mean, you talked a lot about policy uncertainty as well in the previous segment, and I think there is a lot of uncertainty. So we'll see how things play out. We have made it clear that we think the risks are skewed towards more inflationary policies, but nobody really knows what's actually going to happen, right? So we'll have to see how things play out. I think it is worth noting that last time around, there were a lot of expectations that tariffs would be super inflationary, but the dollar ended up absorbing a lot of the shock. There were a lot of exclusions and so on. So the tariffs didn't actually end up being that inflationary.
Well, then going to David Kelly's point, talking about this policy uncertainty and this wait and see, does this basically mean paralysis as you wait for this unpredictability because the incoming administration wants a lot of optionality when it comes to how are they going to enact some of these things like immigration policy and tariffs?
Right. Sorry, I lost you for a bit. I'm not sure what the question was.
Well, are we going to have basically just economic paralysis, this wait and see, and can that in itself hurt the economy?
Right. So we're pretty optimistic on the trajectory of the economy, to be honest. Economic paralysis isn't really our outlook. We think we're going in with significant momentum. We are above consensus on growth for this year, primarily because of structural growth, right? So we see productivity as a big driver of growth over the last couple of years. We think that can continue going forward. So we think we can grow at 2.3% this year with tariffs maybe putting some downside on growth, but then equally, if we do get some fiscal stimulus, that could buoy the growth environment.
Aditya, appreciate your time, sir, as always. Aditya Bhave there of Bank of America Global Research off the back of this inflation print. Aditya.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.